In this video, let's talk about some common investing biases that might be holding you back in your investing journey. The human brain is hardwired to favor certain biases and they can really mess up your investment thesis and eat into your long-term wealth creation. Hopefully by the end of this video, you can acknowledge that you too have some of these biases and start getting rid of them. Let's begin. The first one we are looking into is the overconfidence bias. It is the tendency to overestimate our abilities, knowledge, and future prospects. This is exactly what it sounds like. You become overconfident and start overestimating your abilities as an investor. The Dunning-Kruger effect amplifies this for newer investors. As they say, a little knowledge is a dangerous thing. In fact, I've heard from people that one of the worst things that can happen to an investor or trader is that they make a lot of money right from the beginning. This is because it can lead to unrealistic expectations and overconfidence that can really mess up your long-term thinking. Let's look at some different ways that overconfidence bias can impact your investing style. Firstly, it can lead to overtrading. Overconfident investors often start trading a lot because they think that they can make a lot more money by going in and out of stocks. Over the long run, it can be a risky move because it's very hard for traders to keep consistent returns. This can also lead to high transaction costs that eat into returns. The next one is under diversification. Overconfident investors may hold concentrated positions because they are so confident in their ability to pick stocks. The problem with this strategy is that nobody knows what the future holds. You can go all in into a few stocks. You may become very rich, but you can also lose all your money. Successful investing is a balance of risk and reward. Talking about risk takes us to the next one, that is underestimating risk. Overconfident investors often take out outsized risk because they believe that what they are doing is the right thing to do. They believe that they can handle a lot more market volatility than they actually can. They should be very careful about this. Here are two tips that you can adopt to avoid overconfidence bias. The first one is to keep an investment journal to objectively review past decisions and outcomes. Look for patterns of success and failure. The second one is to seek out diverse perspectives, especially opinions that challenge your own. So basically, you should be confident about the investing strategies you're deploying. In fact, you should not get into anything unless you're confident about it. What you need to stay away from is overconfidence. Trust me, the second you become too cocky in investing, you're going to lose money. The next bias that we are going to talk about goes hand in hand with overconfidence, that is confirmation bias. It is the tendency to seek out and favor information that confirms our pre-existing beliefs while ignoring contrary evidence. Basically, once you get into an asset or make an investment, all you want to do is hear positive things about it, and that is not the right way to go about investing. There are several ways that confirmation bias impacts your investing, starting with reinforcing existing views. So here's the reality of things. When it comes to investing, there's always a bear case and a bull case. What you need to do is look at both of them. But what happens is that once you have gotten into an asset, all you do is seek out the bullish case, which is not the way to go. The contrary of this is also true. When you're not invested into something or you have sold out of something, all you want to do is look at the bear case and not the bull case of it. Both of these are the wrong way to look at things. At any given point, you should be looking at the whole picture, which includes the bear case and the bull case. This in fact covers the next point as well, that you are avoiding contrary information. As I just mentioned, once you have developed some sort of confirmation bias, even when you come across information that negates what you believe in, you will just not look at it. This is again because you're overweighting confirming evidence. Even when you come across a lot of data points, you'll pick the data points that fit your narrative and run with it. You will just ignore everything else. This was actually very well proven in 2021 when everybody was just looking at the bullish side of things. The market kept getting frothier and frothier and everybody just ignored it, and we all know what happened after that. Another point is that you're always seeking confirming opinions. In the age of social media, it's very easy to get into these echo chambers where people tell you that you're right about your investments even when you're clearly wrong. There will always be people who believe in what you believe in. What you need to find is people who can make you question things. Here are some tips to avoid confirmation bias. Firstly, actively seek out information that contradicts your views. Read bearish takes, not just bullish ones. Always assign a devil's advocate to argue the opposite side before making an investment decision. If I had to give you one suggestion, it would be to stay away from echo chambers. Seek out information that can prove you right but also can prove you wrong, and then take your decision. The last thing you want to do is lose money. Talking about losing money brings us to the next bias, that is loss aversion bias. It is the tendency to feel the pain of investment losses more acutely than the pleasure of gains. It just so happens that humans don't appreciate happiness as much as they feel the pain of sadness, and this goes for investing as well. To better understand loss aversion bias, let's see how it impacts investing, starting with holding losers for too long. Investors, especially beginner investors, have a habit of clinging on to their losing positions for a very long time. This is true because of two reasons. The first is that selling out of a position and realizing a loss is very hard. But what's harder is the second reason, that is, you have to admit that you were wrong about your investment thesis. There's also the flip side of this, that is selling winners too soon. There's also the other type of investors. These are people who want to lock in even the smallest of gains because they're scared that the stock might come down again. Holding on to your losers for too long or selling your winners too soon, both are the same thing. You're losing money in both the situations. Loss aversion bias also leads to you avoiding riskier asset classes. Now, if you're somebody who's older and watching this, it's totally okay to not take on too much risk. However, if you're young, you want to find the right balance of risk and reward. For example, if you're in your 20s or 30s, it's totally okay to allocate about 1 to 5% of your portfolio in something like Bitcoin, which is an emerging asset class. You also want to incorporate value stocks with growth stocks and even dividend stocks if possible. At the same time, you should balance it out with a healthy amount of cash, which should be sitting in good high interest savings accounts. After you have made all these decisions, what you don't want to do is panic sell in downturns. Somehow the people who hold on to their losses for too long are also the same people who sell out during massive downturns. In fact, this is how capitulation occurs, and you can see it on the Wall Street cheat sheet. You see this area here, this is the worst time to be selling. And this area up here where you feel the most euphoria is probably a better time to be selling. And if you're a long-term investor, just get used to the ups and downs of the market and just ignore all of this and hold on to your assets. Here are two tips that you can use to avoid loss aversion bias. The first is to automate your investing through periodic contributions to avoid knee-jerk reactions to volatility. And the second is to predetermine your self-discipline for both cutting losses and taking gains. Remove emotion from the equation. What you need to remember is that investing and emotions don't go hand in hand. When it comes to investing, just throw away all your emotions and take rational decisions. The next bias that we are going to look at is called the herding bias. It is the tendency to follow the crowd and copy what other investors are doing. Again, this is becoming so common in the age of social media where people are copy trading each other all the time. There are people on social media who are giving you not financial advice all the time and you're following them blindly without even realizing. So basically what happens is somebody is talking about a stock, let's say on YouTube. You hear about the stock, you get really impressed. Without doing any research, you start buying it. And it's not just you, there are lots of people who are doing this, and that's exactly how you form the herd mentality. Herd mentality in anything is not good, but it's especially bad when it comes to investing, and here's how it affects it. The first is that you are often chasing hot stocks. Now, I don't need to explain this to you. We have all seen the meme stock mania. People invest into companies like GameStop and AMC without even realizing what they are doing. Of course, there's some people who go on and make a lot of money with this, but 99% of the people are out there losing money. When it comes to herding bias, you're also often overpaying for the stock. Herding often leads to bubbles, and that's exactly where you might end up buying the stock. Again, if you look at the cheat sheet, it's the euphoria phase where all this is happening. This is where investors drive prices far above fundamentals. The opposite of this is also true. Herding leads to you selling at bottoms. When the herd is panicking and selling, individual investors often go along with the crowd and sell low. Another thing about herding bias is that it leads to short-term focus. Herding is often driven by fear of missing out, which is all about the short term when people completely ignore the long term. You're out there chasing gains, trying to get rich overnight while completely ignoring your long-term portfolio, and that is the one you should be really paying attention to. Now, here are two tips that might help you out. First, have a written investing plan and stick to it regardless of what the herd is doing. Secondly, as you might have heard 1,000 times, do your own research and focus on the company fundamentals and not just price action. What I can tell you from my experience is that every time I've gotten into the herd mentality, I've gotten wrecked in the market. And all I want for you is to not be in this situation. This is something that has happened to me very recently in 2020 and 2021, so I haven't forgotten it. This brings us to the next bias, that is recency bias. This is the tendency to overweight recent events and assume current trends will continue indefinitely. Again, this is something we all saw so much of in 2020 and 2021. We kept seeing the market going up and completely forgot that there could be a massive crash just around the corner as it happened in 2022. This is also why experience in investing is so important, and people say before you start reporting on your returns, make sure you have invested for at least 5 to 10 years or even more. I find recency bias to be quite fascinating, and here's how it impacts your investing. Firstly, it leads to performance chasing. Investors often flock to asset classes or stocks that have performed really well recently. Just think about how many people ran to crypto back in 2021 when the markets were just going up straight. The problem with that is that once a certain asset has performed really well, it's unlikely that it's going to repeat it over and over again in the short term. Over the long term, sure, it can keep going up, but what you need to remind yourself is that healthy corrections are part of the journey. Performance chasing is also very closely related to to over-extrapolating trends. In the market, stocks have a tendency to revert to the mean. However, investors tend to forget this when everything is so hyped up. If you look at some of these stocks, they crashed massively during the 2022 downturn. However, over the course of 2023 and 2024, they reverted back to their mean. Sometimes stocks just need to take the right path to reach where they belong. The next one is called fighting the last war. Basically, investors often prepare their portfolios for a repeat of the most recent crisis, like hoarding cash after a crash. This is something we saw a lot of in 2023. Because of the 2022 crash, everybody was scared and they kept holding on to cash. This ended up being very expensive for a lot of investors because we entered a bull market and it's been going on ever since. This also begs the question of recency and risk perception. Investors who haven't experienced a bear market may underestimate the risk in their portfolios. This was my biggest lesson in 22. I had never seen a market crash like that ever since I started investing properly. I got caught in a bad place for a while, but I learned what to do and I kept going. One more thing I want to mention is that recency bias also leads to overreaction to news. Investors often assume that the latest earnings report or economic data point is more important than the long-term trend. Over the long term, these have minimal impacts. What you really need to be looking at is the health of the asset you're holding. Now let's look at tips to avoid recency bias. Firstly, study market history and past cycles to get a broader perspective. I recommend you learn more about the 18.6-year real estate cycle and how it correlates to all the other markets. Having said that, don't assume that the recent history will repeat. As they say, history doesn't repeat, but it often rhymes. The second tip is to focus on your long-term plan and avoid making short-term changes based on recent performance. This one's a given. You should always try to focus on the long term when it comes to investing. So when I started making this video, I wanted to cover 10 investing biases, but I see that this video is going on for too long. So I'm going to cover only 6 in this video and I'm going to make another video with 6 more. If you have enjoyed the video so far, hit like and consider subscribing so you don't miss out on the upcoming videos. And now off to the last bias, that is self-attribution bias. This is the tendency to attribute successful outcomes to your own skill and effort while blaming unsuccessful outcomes on external factors. I don't know about you, but I believe that this is happening more and more in the real world as well. A lot of people are trying to blame others and external factors for their failures, but when it comes to success, they take all the credit, and this is true for investing as well. When you get into a good asset or a stock, you tell everybody about it. You tell them, hey, look at me, I'm a great investor. But when you make a mistake, you try to blame it on others or something else. For example, it could be macro factors, or you could be blaming some YouTuber for your mistakes. Let's look at some particular ways how self-attribution bias can impact investing, starting with overconfidence after wins. This is something I just mentioned. Investors who credit their stock picking skill for a few good trades may become overconfident and take too much risk. The second is repeating mistakes after losses. Investors who blame outside forces for their losing trades may fail to examine their process and improve their decision making. These two are basically two sides of the same coin. You need to learn from what you are doing, whether it's the right or wrong decision. If you make a right decision, don't become overconfident. Learn from it. Try to understand how it ended up being a right decision. At the same time, when you make a wrong decision, learn from it. Don't try to blame it on others or external factors. Understand why you made the mistake so that you don't make it again. There's also a factor of lack of learning. Investors who blame the market for losses may never develop the self-awareness to improve. You need to understand that mistakes are a part of investing. You will never consistently win in the markets. Over the course of your lifetime, you're bound to lose money on some of your trades. What you need to focus on is the long-term growth of your overall portfolio. So here are 2 tips that you can use to avoid self-attribution bias. The first one is something we discussed before. Keep a decision journal to honestly review your process, including both successes and failures. The second is to focus on the process over outcome. Evaluate your decisions based on the quality of your process, not just the result. Basically, as I mentioned, you need to understand what you are doing and why you are doing it and keep a track of it. In the past, I've actually blamed other YouTubers for the mistakes I was making. There are so many YouTubers and social media personalities out there nowadays, and they're shilling you so many different things. It's your responsibility to filter out the information. If you win, it cannot be because of them, and if you lose, it cannot be because of them. It's all on you, and it'll always be all on you. Imagine if you're listening to somebody today. What if they're not there tomorrow? What are you going to do then? This is why it's important to understand why you are taking the decisions so that you can continue taking the same decisions for yourself. Overall, what I'm saying is take charge of your portfolio, take charge of your decisions, and take charge of your own wealth. So those were the 6 investing biases I wanted to cover in this video. As I mentioned before, I actually wanted to cover 10 to 12, but because this video went on for too long, I made it shorter, and I'll cover those in another video. From this video, the key takeaway is that we all have these biases hardwired into our brains, but we can mitigate their impact by being aware of them using tools like decision journals and checklists, seeking out diverse perspectives, and sticking to a long-term plan. It takes discipline and humility, but it's worth it to become a good and rational investor over the long term. I'll see you next week in a new video. Till then, keep learning and stay on top of your finances. Until next time.